Here's a question. Imagine it's Monday morning. The alarm goes off at 6, you drag yourself to the kitchen, pour the coffee, and before you even take the first sip, you open your banking app, and you see it. That same number, that same automatic withdrawal that came out overnight. Your mortgage payment, about $2,800, gone. Every single month, like clockwork, like a landlord you can never get rid of, living right inside your bank account. And you tell yourself, okay, that's just life. That's just what having a house costs. That's the deal you made. But here's what most people don't realize. The moment that payment disappears forever, everything changes. And I don't just mean financially. I mean something shifts in your mind, in your decision-making, in the way you move through the world. Today we're talking about what actually happens after you pay off your house. Not the stuff the internet tells you. Not the, oh, you should have invested that money instead debate that gets recycled every 6 months. We're going deeper than that. We're talking about the psychology, the cash flow transformation, the career freedom, the investment acceleration, and honestly, why this one milestone might be the single biggest financial unlock of your entire adult life. My name is James, and I spend way too much time thinking about the mechanics of mortgage payoff and what happens on the other side. If you're someone who has a mortgage hanging over your head and wonders whether the sacrifice to pay it down faster is actually worth it, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. All right, let's get into it. Here is something that surprised me when I first looked it up. According to U.S. Census Bureau data, nearly 40% of American homeowners have no mortgage at all. They own their homes free and clear. Now think about that for a second. Almost half of all homeowners are living without a monthly mortgage obligation. No bank they owe, no lender in the picture, no automatic withdrawal hitting every month. And the average monthly mortgage payment in the United States right now sits around $2,883. That is over $34,000 a year, every year, going to the bank. Not building your wealth, not funding your retirement, not creating options for you, just keeping the lights on inside a debt agreement you signed years ago. So what actually happens the day that stops? This is where it gets really interesting. Because when most people think about paying off their house, they focus on the obvious. No more payment, save on interest. Great, done, check the box. But there are layers to this that go way beyond the surface level conversation most people have about it. Let me walk you through what I call the 3 phases of the mortgage payoff transformation. Phase 1 is the psychological shift. And look, I know we live in a world where people love to dismiss the emotional side of money. The math crowd will tell you, feelings don't matter, only returns matter. And I understand that argument. But here's the thing. The research actually backs up the psychology here. Multiple studies have confirmed that eliminating debt has a measurable, direct effect on self-esteem, sleep quality, and overall mental well-being. One analysis found that the stress reduction from becoming mortgage-free was comparable to receiving a significant pay raise, not a small bump, a meaningful raise, because your brain is no longer carrying the weight of that obligation in the background every single day. There is a quote I think about a lot on this. A physician once said to a colleague, "You can tolerate a lot of financial turbulence if your house is paid off." That one sentence says everything. When the stock market drops, when your job feels unstable, when something unexpected and expensive hits your life, the person without a mortgage has a floor, a foundation, something that cannot be taken from them as long as they pay property taxes. And that changes how they handle every other financial decision. And this matters more than people realize, because fear is expensive. When you are scared about your financial baseline, when you feel like you are one bad month away from missing a payment, you make worse decisions across the board. You don't negotiate your salary because you cannot afford to rock the boat. You stay in a job you hate because you cannot risk the income. You don't start that business because the stakes feel too high. You don't invest aggressively because any loss feels catastrophic. The mortgage is not just a financial obligation. It is a psychological ceiling that caps how freely you can move. Phase 2 is the cash flow transformation. This one is pure math, and the numbers are genuinely stunning when you sit down with them. Let's say your mortgage payment is $2,800 a month. The day that payment stops, you have $33,600 per year that was previously locked inside that obligation. Now, freed up, fully redirectable, every single year. Here's what most people don't realize about that number. Most Americans who fully pay off their mortgage are somewhere between their late 40s and mid-50s. Let's say you're 50 years old, and you redirect that $2,800 per month into a broad index fund, earning the market's historical average of roughly 10% annually. Over 15 years, you are looking at over $1,100,000 in accumulated wealth. From a payment you used to make to a bank, simply redirected to yourself. That is not a projection pulled from thin air. That is the math of compound interest doing exactly what it always does when you give it enough time and enough runway. Now, somebody out there is already typing in the comments, but James, you should have been investing that money instead of paying off the mortgage all along. And look, that is a real and valid debate. I am not dismissing it. But here is what that argument consistently misses. 1. It assumes perfect human behavior. It assumes you would have actually invested that difference instead of spending it on lifestyle inflation. 2. It assumes you had the emotional resilience to stay invested through every market crash, every correction, every down year, while still making that mortgage payment at the same time. And 3, statistically, most people don't. Most people panic sell at the bottom. Most people absorb raises into their spending rather than routing them to investments. The guaranteed return of eliminating a debt is underrated, precisely because it removes the human error variable entirely. The mortgage payoff does not require discipline every month. It does not require you to stay calm when markets crash. Once it is done, it is done. Phase 3 is what I call the courage factor. And this one barely gets talked about anywhere. When you own your home free and clear, something counterintuitive happens. Your actual risk tolerance goes up, not down. You might assume that someone who has paid off their house is now ultra-conservative, hoarding cash, avoiding all risk, playing it safe. But what happens in practice is exactly the opposite. Because when your housing is fully secured, when you know with certainty that your family will always have a roof, you are now free to take bigger swings everywhere else. Entrepreneurs know this intuitively. People who start businesses in their 50s after decades of building equity in a home frequently cite the paid-off house as the thing that finally gave them the nerve to take the leap. Because the downside scenario is no longer catastrophic. You still have your home. You have a floor. And that changes the entire calculus of risk. This is where it gets really interesting from a wealth-building perspective. Because the people who pay off their home and then redirect that payment into investing are often building wealth faster than the people who kept the mortgage and invested the difference. Not because the math is better, but because their behavior is better. They are calmer. They are more patient. They hold through downturns because they are not stretched thin. They buy more when markets are down instead of selling because their baseline is secure. Let me shift and talk about something that does not show up in any spreadsheet. The relationship between a paid-off home and what happens to your career. Think about this carefully. If you have a $2,800 monthly mortgage payment, how much gross income do you actually need to maintain your current life? A lot. Your break-even number is high, which means you are essentially locked into maintaining a certain salary level at all times. You cannot freely step back. You cannot take a lower-paying job you genuinely love. You cannot reduce your hours, go part-time, take a sabbatical, or walk away from a toxic work environment without significant, immediate financial pain. But the day your mortgage is gone, your monthly break-even drops dramatically. Suddenly, you need far less income to cover your actual needs. And that changes your power in every professional situation you find yourself in. In salary negotiations, you are not desperate. In career transitions, you can afford to be patient and strategic. In a toxic work environment, you can walk away. The person without a mortgage has leverage the person with a mortgage simply doesn't have. There's a reason that communities focused on financial independence talk about housing cost as the single biggest lever in your financial life. Not the daily coffee, not the subscriptions, your housing. It is the largest expense in the average American household. When you eliminate it, you have pulled the most powerful financial lever available to you. Now let me address the debate directly, because I want to be honest with you and not just tell you what feels good to hear. Should you pay off your mortgage or invest the difference? My actual take, and I think it is more nuanced than most people are willing to be, the answer depends on the math and on who you are. If you locked in a 3% rate back in 2020 or 2021, the math says invest. The market has historically returned far more than 3% over long periods. The spreadsheet answer is keep the cheap debt and invest aggressively. That is the correct mathematical argument, but here is what that argument perpetually misses. 1, you need the discipline to actually invest that difference every month instead of spending it. 2, you need the emotional stomach to watch your portfolio drop 30 or 40% in the bear market while still making that mortgage payment and not selling in panic. 3, you need the time horizon to wait for the recovery. And 4, life is unpredictable in ways that no spreadsheet accounts for. Job loss, health events, family needs. The scenarios that derail people financially almost always involve fixed monthly obligations that cannot be paused. The psychological piece of a paid-off home is a real return on investment. It simply does not show up in a compound interest calculator. And for a very large number of people, the clarity, the courage, and the expanded freedom it creates will generate more actual wealth than the mathematical arbitrage between their mortgage rate and market returns ever would. Here is how I think about it practically. If your mortgage rate is at or above 6% in today's environment, paying it down aggressively is almost always the correct move mathematically. If your rate is 3 or 4%, the math favors investing the difference, but only if you actually do it with discipline and stay the course. And either way, the real answer is build both simultaneously. Because the goal is not just maximum mathematical returns. The goal is options, freedom, the ability to make choices from strength rather than necessity. Let's talk about the practical side, how to actually accelerate this if you have decided you want to get there faster. The first move is the bi-weekly payment approach. Instead of making one full monthly payment, split it in half and pay every 2 weeks. Because there are 52 weeks in a year, you end up making 26 half payments, which equals 13 full payments instead of 12. One extra full payment per year, every year, without changing your monthly budget. On a typical 30-year mortgage, that single adjustment alone shaves 4 to 6 years off the loan term and saves tens of thousands of dollars in interest. Second, every time you receive a raise, a bonus, a tax refund, or any financial windfall, route a meaningful chunk directly to your mortgage principal. Not to upgrading your lifestyle, to the principal. Because every extra dollar you put toward principal in the early years saves you multiple dollars in interest over the remaining life of the loan. Third, simply round up your payment. If your required payment is $2,200, pay $2,500. The difference feels small monthly, but over the full life of the loan, it translates to years removed from your term and thousands preserved. Fourth, refinance strategically if rates move in your favor. If rates drop significantly below what you are currently paying, and you plan to stay in the home long enough to recoup closing costs, refinancing and maintaining the same payment accelerates payoff significantly. Now, here is a mistake I want you to avoid completely. Some people get so focused on paying off the mortgage that they neglect their retirement accounts, particularly the employer 401k match. Do not leave an employer match on the table to pay extra on a mortgage. A 100% match on your contribution is an instant, guaranteed, immediate return that nothing in finance can beat. Get your full employer match first. Build your emergency fund. Eliminate high-interest consumer debt. Then, and only then, begin routing extra dollars toward the mortgage principal. The sequence matters enormously. Let me leave you with this thought. Most people spend their entire financial lives feeling like they are behind, like the money is always being managed for them, by the bank, by the lender, by the credit card company. Every month, money leaves automatically, and they just have to make sure enough comes in to cover it all. That is not ownership. That is management. Financial management on someone else's terms. Paying off your house is the moment that relationship inverts. Suddenly, you are the one in control. The bank no longer holds the single largest piece of your financial life. And that moment, when you make that final payment, when you watch that balance hit zero for the last time, when the deed to your home is fully and unambiguously in your name, that is not just a financial milestone. That is a transformation, a fundamental shift in how you relate to money, to risk, to your career, to your future. The people who have reached it will tell you, it is not just about the numbers. It is about how you see yourself, how you move through the world, the decisions you feel genuinely empowered to make, the risks you now feel free to take, the opportunities you can say yes to because you are no longer financially cornered. And I think, deeply, that is worth working for. If this video helped you or shifted your outlook on mortgage payoff, do me a favor, share it with someone who is on the fence about whether paying down their house is worth the sacrifice. They need to see this. I'll see you on the next one.